Hello and welcome to Market Domination. I'm Julie Hyman, Jared Blickery in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The company is going to clearly beat expectations on top line and EPS, and will likely see a very positive guide. And I based a lot of this analysis on two or three core things, which is look at demand. Demand is off the rails.
Nvidia has been important for a very long time. Obviously, everybody's familiar with AI. It's still in its infancy, but it's not going away anytime soon. And I think many people, and I share this opinion, AI is going to change things as much as the internet did when it came about 30, 40 years ago. So that's very, very important. And as you said, it's been a key component to the overall growth in this market.
We are likely in a low Fed cut cycle right here. And that is absolutely Goldilocks for stock markets. If you go back and look at all the 8 cycles going back to 1950, and you look at all the slow cut rate cycles, the average return from the very first cut is about 23%.
We've got an hour and go until the market close. So let's take a look at the major averages here. The Dow, the weak link here today, it's off almost 0.5% and it's been deteriorating throughout the session. But if we look at the S&P and the Nasdaq, both of them are on track for a record close. Although the S&P 500, it'll be a little bit more by the skin of its teeth here. It's up just about 0.1% right now. The Nasdaq, the strongest of the three today, up 0.6%. We've got a lot of bond issuance this week, but there is focus on the government issuance, but also there's a lot of corporate debt issuance this week. So that's something that bond investors are watching. As we see the 10-year T-note, a little change right now, 4.44%. As we look at what's going on with the sectors here, financials are the big loser today, being dragged lower by JPMorgan after its investor day. We will tell you more about why coming up a little bit later in the show. Energy and consumer discretionary also weak. On the flip side, tech, the big winner today. Jabil Circuit, the contract chipmaker, electronics maker, leading gains there today after its earnings. Industrials also doing well. And just quickly as well, want to go back and take a look actually at what's going on in the commodity market today. We're going to talk much more about metals later in the session here. And you've got crude oil off a little bit, but man, there still continue to be some fireworks in the metals. Copper trading near a record here. Gold continues to push higher, and silver continues to push higher. In today's playbook, we'll get some opinions on how to play what's going on in the metals, Jared.
That's right, Julie. And the S&P 500 fighting for another record day, while the Dow is back below the 40,000 level. But our next guest sees only more gains ahead for the benchmark index, calling for the Dow Industrials to hit 60,000 by 2030. Joining us now is Ed Yardeni, Yardeni Research President. Ed, thank you for joining us here today.
Thank you.
Let me just ask you about your call here. That would be a 50% rise if the Dow went from 40,000 to 60,000. I just did the math. We went 50% in the last 4 years from 20 to 40. So there you go.
Yeah, I think the economy is performing extremely well in the face of what seem to be high interest rates. But I think increasingly it's becoming clear that interest rates are simply normalized back to where they were before the great financial crisis. And meanwhile, inflation is moderating. So I don't think that we actually need the Fed to cut interest rates for the market to continue to go up on earnings. I would prefer that it goes up on earnings rather than valuation, because valuations are already a bit stretched.
Ed, hey, it's Julie here. It's good to see you. So what convinces you, what's going to be the main sort of tailwind for the continued gains in earnings that you are expecting?
Well, I think productivity is the big story from a macroeconomic standpoint. We have a shortage of skilled workers. I think companies are seeing that their business is really quite good, even with the global economy kind of muddling along. It's not exactly booming, but U.S. companies are doing extremely well. We've got analysts raising their expectations for earnings in 2025 and 2026. And so I think companies are going to want to take advantage of the strong environment that they're seeing by increasing their productivity so they can bring their goods and services to the market. If they can do that and using technology, then I think we're going to see better than expected economic growth, lower than expected inflation, with real wages going up and expanding profit margins. So put it all together, and you've got a great scenario for the market to continue to move higher.
And can you talk about some of the importance of that technology, a lot of which is based on AI, at least that's where the hype is. We've seen this play out in the chip market with Nvidia, but we've also seen the infrastructure play, the electricity play, all these other things, copper at record highs. Where do you see that fitting in?
Well, I think all these things are, there's a lot of moving parts here, and as you just indicated, and I think that the technology revolution that started in the 1990s has evolved to the point where a lot of these technologies are very user-friendly. They're relatively affordable. They're relatively easy to operate, and they have tremendous impacts on every business. I think every business these days is a technology company. They either make technology or they use it. If you don't use technology to increase your productivity, you're going to kind of lose it. You're going to be out of business. So I think that's where the story lies, is in the productivity boom, based on the productivity revolution.
Ed, what do you think is the biggest risk to further upside in the market?
Well, there's always risk, and clearly there's still plenty of geopolitical risk. Look, recessions tend to lead to bear markets, or bear markets anticipate recessions. The market didn't do a very good job of that in 2022. Expecting a recession that never happened. But usually recessions are caused by credit crunches, and at this point, I don't see something like that. But a spike in oil prices is something that, from a geopolitical perspective, is still not out of the realm of possibilities here. Fortunately, the price of oil has actually moderated quite a bit ever since Israel and Iran launched missiles at each other and then kind of backed off. So I think there's enough oil so we don't get a kind of big spike the way we had in the 1970s when we had two spikes. And now this decade, we had one in 2022. I don't think we're going to get another one, but that would be the risk.
Let me ask you about sentiment here, and we can measure that a few different ways. One way is the equity put to call ratio. I guess where I'm coming from is we see the indices at record highs right now, but we're not seeing those frothy valuations. We're not seeing the euphoria that we've seen at other extremes. So where do you see the path forward, and where do you see that euphoria and perhaps sentiment that gets too elevated? Where do you see that coming in?
Well, sentiment has been pretty flaky of late. A few weeks ago, it got really high, and then in April we had a sell-off, as you typically do when there are too many bulls and not enough bears. And then the bears came in, and now we're back to seeing a lot of bulls. But all in all, I think the market is in good shape from a fundamental perspective in terms of earnings. Valuation is definitely stretched, but all in all, with the economy doing well, and the first quarter earnings season turning out to be really better than expected, I think we've got the market in still fairly good shape to make more gains.
And it's interesting to me that you're somewhat, I don't know, Fed agnostic is the right way to characterize it, but Fed agnostic when it comes to the long-term continued returns of the market. But when you watch the Fed here, what is your current thinking? Do you think we will not get an interest rate increase this year? I think the last time we talked, maybe we're still looking for one in December.
Well, they just won't listen to me. I told them to take the rest of the year off, and I haven't heard them announce that they will do that. But I don't think the economy needs rate cuts. The economy is doing fine. I don't think any rates increases either. Look, I think the economy is going to continue to grow with inflation moderating. Why mess with a good thing? Why mess with success? My concern actually is if they do come in and lower interest rates, then we'll have something more like the late 1990s, where "Party Like It's 1999" would be the song that comes to mind. I don't want to see a melt up in the technology-led melt up the way we had in the late 1990s, followed by a tech wreck, as we all recall from what happened back then.
I don't want to see that either, but I'm all in favor of giving the Fed a few months off, maybe till the end of the year as well. Thank you, Ed, as always.
Thank you.
We are just getting started here on market domination. And guess what? Coming up, Microsoft is going all in on an AI for the PC. The company unveiling a new category of computers and software today. We're going to get the details on that later in the hour.
And at 4:30 Eastern, it's the debut of our new show, Asking for a Trend. We've got you covered with the latest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned, more market domination after this. Time now for the day's trending tickers. JPMorgan Chase CEO Jamie Dimon speaking out at the bank's annual investor day. He addressed the succession question as well as calls for more buybacks while also raising forecasts for a key revenue metric. It was pretty action-packed, in other words. Here to discuss is someone who was there, Yahoo Finance's David Holleris. So David, give us the sort of most important takeaways.
Yeah, so in a wide-ranging Q&A, Jamie came out after his executive team gave presentations about various parts of, JPMorgan Chase, which is a sprawling, enormous, the largest bank in the country. And effectively, he weighed in on AI, saying it's a little bit like exercise now. We're beyond the debate about talking about whether or not it's important. He also addressed the bank's excess capital. JPMorgan has a lot of extra capital, even by their own standards, saying that he did not want to buy back more of the stock at these prices. Now, he always cages that as it being a personal judgment. Earlier today, CFO actually did touch on maybe more buybacks being in the cards, being a possibility. Jamie Dimon also did talk about his succession plans, And he didn't give
5
us
years?
he didn't give us a date per se, but last year he sort of made a comment about how he had 3.5 more years. And this year, when asked how long he would stay, he said it's not 5 years anymore. So what we're taking from this is sort of that he is being a little bit more clear in vocalizing the fact that he's not going to run the bank forever.
Anything that you gleaned from just the tone? You were there among the participants. We're only a few years back into the return out of hiding here from COVID. Just what was the mood like there?
Yeah, I think the most interesting thing, the consumer and community bank, the biggest part of JPMorgan Chase, is running fairly smoothly. But then we have this combination of the commercial bank and the investment bank and trading and all these other things. That's CIB, the commercial and investment bank. And that's a new reshuffling of management. So it's a little bit of a new team forming, and it's a pretty complicated multinational team they're working with. So that's sort of where I think we'll see the new from JPMorgan come. Outside of that, I think artificial intelligence is something that every executive brought on and talked about. So, we want to hear more about that.
And just a quick comment on the stock. It seems like it is going down on the buyback comment specifically, that they're not buying back shares at this particular price.
I mean, without ever having a true answer for what the market's doing, it seems like that's probably where the stock began selling off around the time Jamie started speaking. So.
Gotcha.
All right. Well, thank you for the boots on the ground there, David Hollerith. All right, Instacart shares sliding after its chief financial officer was looking to manage expectations over the company's gross transaction value guidance, saying at a conference, this was a JPMorgan conference, it will not exceed the previous estimates. And Julie, I was looking at the Wi-Fi Interactive here. I hadn't shown our mobility dashboard in a little bit here. And here we can see, let me get the year-to-date totals. There we go. And I'm not sure what happened to CART here, so maybe that fell off my radar. Anyway, my point was we do have a trend that some of the actual providers of ride sharing and also these delivery services are doing well, while the rental car business has just really taken a hit. But beyond that, this is a comment that comes from CFO Emily Reuter at the JPMorgan conference, and she said basically she doesn't expect them to exceed their gross transaction value guidance. So there had been some speculation that they would. They just said they wouldn't, and stock takes a little bit of a hit.
Yeah, and just for some perspective here, the stock is up some 40% year to date, but it is down about 16%. It closed at a record high on April 5th, and since then it's fallen about 16%. So, remember it just came public in last September, and that gross transaction value forecast just came on May 9th. That's when the company came out with the forecast. It was in line with what analysts were expecting, and the stock went down. So maybe there were still some hopes out there. Well, maybe that wasn't the last word on it. Maybe they were going to come out and beat that forecast, and she seems to be putting that to bed with a comment today. So
there you go.
That explains the tumble. Another stock that's trading today, Hims and Hers Health. Those shares are soaring. The company announcing it will unlock access to injectable GLP-1 medications. That move to expand what it calls its holistic weight loss program. Remember, Hims and Hers, online purveyor of various types of medications. And the stock is up a lot, which always leads me straight to the short interest chart, right? Because the short interest here is about 12% of float, relatively high. So you got to imagine there's something of a short squeeze there. The other thing is, most of the analysts I saw said that they expected, that the company had already sort of telegraphed it was doing this. So it's interesting to see such a dramatic move.
Yeah, and it's one of those somewhat new issues. It's not widely held just yet. They're kind of getting their footing, and so that would be a prime short squeeze candidate. I do have some commentary from Citi. They rate Hims a buy with a price target of $16. They said it's interesting that unlike a few competitors, Hims is only offering compounded GLP-1s, and this is for $199 a month, or $199 a month, steering clear of cost access issues associated with the branded offerings. That would be Wegovy, Ozempic, but that's just for now. It could change later. He thinks the Hims program may be met with some controversy as it does introduce more regulatory and legal risk into the model. So, I mean, in a highly regulated industry, I got to think, okay, that could carry some weight. But then you also note the tremendous upside side, you look at an Eli Lilly chart, that's evidence for the potential of this market,
Right.
especially in a smaller competitor.
Yeah, or Novo for that matter.
Yes.
That's the other poster child. Well, President Biden last week announcing $18 billion in tariffs against China. One industry those tariffs are meant to benefit is solar, as U.S. producers have been struggling to grow amid competition with China. Our next guest says we're one incident away from supply chain disruption and job losses. For more, we're bringing in First Solar CEO Mark Widmar. Mark, thank you so much for being here. So talk to us about your thoughts on these tariffs and what you mean by the sort of insecurity or your view of the insecurity of the supply chain.
Sure. The tariffs that were announced last week were just another step in trying to create a stable policy environment to ensure that there's a level playing field, here in the U.S. to make, meaningful investments. I'm here today in our R&D facility, first of its kind, almost a $500 million investment that we're making here in Ohio, not just for manufacturing, but for innovation and next generation technology. Those types of investments that you make that have to be enduring for multiple years need to have the backdrop of a stable policy environment so you can ensure you can get a return on invested capital. So the type of policies and tariffs that were put in place, announced last week, plus some of the other changes made by the administration, give companies like mine, as well as others, confidence to make these types of investments.
So, yeah, I noticed that your stock happens to be up 13% this year. A lot of your competitors' stocks is down for the year, quite a bit more. What policies do you think you've implemented that have allowed your shareholders to treat your stock a little bit better than some of your competitors?
Look, I think it all started with the, Inflation Reduction Act, that was announced a couple of years ago now, almost 2 years ago now. That enabled kind of this first of a kind opportunity for this industry, a whole of industry approach that could now see across the balance of this decade, whether you're a developer, whether you're owning a generation asset, whether you're part of the supply chain, to really understand a demand profile that was enduring. So it starts with that. So it's kind of like the first step in the industrial policy. The domestic content policies that have come out now that enable or support domestic manufacturing is another step, and then the level playing field is the third step in that process. And once you have all three legs to the stool, you have an opportunity to see the type of growth that we're demonstrating here, not just with our R&D facility, but we're making expansion to manufacturing capacity outside of Ohio into Louisiana and Alabama. And when we see ourselves through the next couple of years as we exit 2025, we'll have 14 gigawatts of capacity, and maybe that's not really a number that a lot of the listeners fully understand. So maybe translate that into jobs. We'll have created direct, indirect, and induced jobs, 30,000 jobs here in the U.S. with a domestic manufacturing supply chain and a $2.8 billion annual payroll impact. So that's what we're doing by making investments here in the U.S. We provide certainty to our customers, and it's showing up in the demand for our product.
Mark, while these tariffs may be good for the domestic solar industry, they're not necessarily good for the domestic energy transition. For example, if you were just talking about the installations that we have seen here in the U.S., I believe that the U.S. Last year installed half the amount of solar capacity as Europe, for example. Europe doesn't have tariffs. They're importing that cheap stuff from China. And because of that, they are much further along in their solar installations. So do you have here a problem where the need to have an energy transition is a little bit in conflict with the need to support domestic solar production industry?
Yeah, Europe's faced with a different dynamic right now, and it's really driven, obviously, between the Ukraine-Russian war and the heavy dependence on an adversarial country for natural gas. I mean, that's the reality of what happened, and they had to pivot very quickly and accelerate, their deployment of alternative energies and renewables, whether it's solar or wind being one of them. But they're also very vulnerable now because now they've traded that potential adversary counterparty, which was Russia, now for dependency on China. You're right. 99% of the product that is going into Europe is supplied from China. And we all know that China also has a tendency towards retaliation, and Europe is actually taking some actions right now trying to create a more level playing field, and the Chinese are actually starting to retaliate. I think when you look at what we're doing here in the U.S., I think you have to have a strategic lens that plays the long game around how do we ensure long-term energy independence and security, and how do we ensure that we don't have over-reliance on any one particular country, especially one that could be an adversarial counterparty. Solar is very competitive. The impact of these tariffs are going to be relatively de minimis. And really, they're only there in place because China has created such oversupply and overcapacity. And even in their own market right now, they're selling below cash cost. I don't see why we as a country, or really any country, should have that ripple effect come into their domestic market. If China wants to create significant overcapacity, 3 or 4 times their domestic demand, let them do that and let the bloodbath stay in China. There's no reason it should bleed into the U.S. as an example. But let me get back to the point on pricing. Tariffs. Let's say the tariffs add 10 cents a watt to a module. That to a power price is about $3 a megawatt hour. To a kilowatt hour, which is what most ratepayers see, it's about 0.3 of a cent, and it's a fixed price for 35, 40 years that you own that generating asset, because other than the sun taking photons and making electrons, there is no input cost. There's really no moving parts. So it becomes deflationary by definition. So I think we have to look long-term and strategically. Yes, some tariffs may be needed near-term to allow a domestic industry to scale. But when you look across the horizon and what value proposition that's being created, I think it's well worth the short-term impact to the extent there are any for the long-term potential.
Mark, as you mentioned, there are also incentives in place here in the U.S. Through the IRA. Your company is going to be the beneficiary of, I believe, an estimated $1 billion this year through Section 45X of the IRA. You also, it's my understanding, would push not just for tariffs on China, but also on some of the other solar panel producers, places like Vietnam, the Philippines, Malaysia. It's my understanding. Why do we need all those measures? In other words, if you're already getting these incentives in the U.S., the tariffs are already on China, why then also the tariffs on some of our trading partners that are not adversaries?
Yeah. Let me put in perspective one thing first on the benefit of IRA. Put it in perspective relative to the investment. I mentioned the R&D facility that we're making here, one of a kind, first of its kind, to really evolve and allow for next generation technology to be developed. That's about a $500 million investment. In my new factory expansions that I've made in Alabama and Louisiana, plus the investment we were making here in Ohio to expand existing capacity, there's another $2.5 billion. So I'm making $3 billion of investments here in the U.S. market before we're really receiving any meaningful benefit from IRA yet. So I want to put that in perspective. As it relates to the impact to Southeast Asian countries that are part of the most recent petition, they're all Chinese-owned and controlled companies, right? So that's the root of this challenge that we're still trying to deal with. China has basically circumvented the tariffs that they were put in place directly against China by moving some production into Southeast Asia and some of the countries that you mentioned, but they're still heavily subsidized through supply chains that come from China, through tooling and equipment that comes from China, even through Belt and Road type of initiatives and low-cost financing. So if that's the fundamental that still needs to be addressed, because of the circumvention, because of the movement of the supply chain, the vulnerability still exists, and this is really to address Chinese-owned and controlled companies that happen to move some portion of the supply chain into Southeast Asia.
Mark, thank you for your time today. Really appreciate it.
All right, thank you very much.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into 2 stocks to help you make the best choices for your portfolio. Stay tuned, more market domination after this. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're dialing in on the narrative divergence of two property and casualty insurers. Joining me here to discuss, Barron's senior writer, Al Root. Al, it's good to see you. Thanks for being here.
Thank
you. So let's get to the stock you like, first of all, in this property and casualty universe, and it's AIG, American International Group. So let's go through why you like it. The stock's done pretty well over the past year, but despite that, you say it still looks cheap on a PE basis.
Yeah, a couple of things. One is performance is improving. So on 2025 numbers, it's trading at about 7 times operating profit, which is a very attractive level relative to the group. It's also trading for about 1.2 times book value, also relatively attractive to the group.
All of these are good things if you're looking for a good buy. And this at a time when we are seeing some of the underlying profit metrics improve.
Yeah, now we're going to do we'll unveil its challenger in a second here, but the overall trends for property and casualty insurance, right, insuring you and me and all of our stuff, they're fairly positive. Profitability is improving, return on equity is improving. Rates are going up. We all know we're paying more for our insurance.
Yeah.
That tends to benefit these players. And I still think to a certain extent, people, when we were just talking, lump AIG, they have this flashback to the great financial crisis. It's a totally different company with different leadership. And it's really poised, I think, to start to close the gap versus some of the leaders, which we'll talk about in a second.
I mean, effectively, it's back to being a boring old insurance business, which sometimes, as we learned from the financial crisis, is not a bad thing.
No,
right? That you're not in these complex financial instruments. You alluded to the leadership here. Peter Zaffino took over a couple years ago, and you think he's in a good place.
Yeah, it's interesting, right? Value investors and investors all the time like to go to the management transition. Oh, and we sort of jump right in. But actually, the data shows that about 2 years in is a really good time to sort of revisit management changes. Takes about a year to get all the people you want at the first level of management, another year to implement all of your processes and lay out your vision to everybody else. Zaffino's been there for a couple of years. He sold some of the life insurance business in the UK. He's exited the reinsurance business. And based on that theory, it's really good time. We were chatting with Bill Nygren of Oakmark Funds, and he is a big fan of Zaffino, and thinks that right now is a good time for him, and we'll see his vision and expanding profitability in the next couple of years. Interesting.
Okay, so what could go wrong here? Big picture economic risks.
Well, big picture, it's an insurer and it's a financial. So, Jamie Dimon retiring can knock multiples for all financial stocks down as we see today. However, it pretty much is a PNC cycle issue, right? So I don't see, to put it this way, I don't see the big risk being execution, right? Looking back over the last 16 quarters, just before a new CEO got there, they haven't missed estimates. It's become a much more leaner, stable business. So it's much more about the P&C cycle turning. Right now, things are fine, but if curves get inverted and things like that happen, it'll knock this one down.
Quick question for you on the phenomenon we've seen of insurers pulling out of certain states or certain regions that they are finding more difficult to insure. Is that something that affects AIG?
This is much more traditional property and personal lines business, right? So to the extent that you're just insuring your house or you're just insuring contents and things like that, it's not as big a deal. Reinsurers, these are questions for the Warren Buffetts of the world more than AIG in these days.
Gotcha. All right, so speaking of Warren Buffett, let's move to the stock that you don't like as much, because it's one that Warren likes, which is surprising. So it's Chubb. The stock obviously got a big leg up after it was revealed that this was one he was investing in, but it's near all-time highs now.
So this is the problem. We love to follow Warren.
Yes.
We love his investment logic and reasoning. The problem is he was buying this much lower. The Buffett bump sent it to all-time highs. It has a pristine track record. But the bottom line is there's less. I am a big fan of the rate of improvement. There's sort of no improvement. It's already a top insurer as evidenced by Warren's buy. So Wall Street doesn't expect much operating improvement over the next 2 years in terms of profit margins and absolute dollar of profit generated. So that leaves it trading at about 12 times operating profit on 25 numbers versus that 7 times we have for AIG. Evan Greenberg, he's great. He's a legend. It's already has 20%, 21% return on equity. You don't see that improving much from here.
Right.
So that whole combination says Warren knows what he's doing, but I'll avoid it.
Yeah, and so kind of what you were saying. No, I mean they've already gotten that profit. They've already squeezed the profit out of the business, is what you're saying.
Yeah, and it's the same sort of trends, right? The P&C business is performing well, and they're beating estimates and doing things like this. It's just a question of how much do you want to pay for it, right? If you just look at Wall Street target prices, which I like to do just as a guide, Buffett's bump took it to beyond where analysts. The average target price was 270. The stock was trading at 274. So it's sort of, all of the good news got reflected. The reverse is true. There's still some upside based on price targets for AIG. So while I too venerate Warren, I'm going to throw that one over the top.
Well, and one more thing to consider. You talked about that he was buying lower than when he revealed it, obviously. The other thing is he's probably going to hold it longer than most people do.
Yeah, now I come from Barron's, right, and we tend to do things, our stock picks, on a 1-year basis, right? 1 or 2 years is our typical time horizon, and I think Warren will be happy owning this for a decade or 20 years, and he'll revisit it, or
his successors,
Greg and,
whoever it will be. Right. Berkshire Hathaway.
That took a turn.
Will revisit it.
Yeah, Berkshire will revisit it in 10 years, and they have a longer term time horizon. And they're folding it into their other insurance operations and looking for synergies. I just think that the outlook for AIG over the next 12 to 24 months is much stronger.
Better. All right, let's talk about what could go right for Chubb, though, that would make it do better. It's just that it does better than expected.
It's always an execution story, right? To some extent, I'm saying that AIG can catch Chubb. But strong execution from Chubb and smart moves from Mr. Greenberg will continue to help that stock.
What are the chances Berkshire would outright buy a Chubb?
That's the risk, right?
Yes.
So I'm saying throw it over. Our Andrew Barry predicted, well, maybe Warren is interested in it. Maybe he could pay $320. He was doing some math. That's about 20% above recent levels, right? So the risk is Berkshire says, you know what? I'm going to take over the whole thing. That hasn't happened in a while. There's no guarantee. He owns about 6% now. That was what was disclosed. That sent that stock up so much. So I can't tell you it won't happen. But the biggest risk would be
that he does something
like that. Hopefully, that would revalue the entire sector, and AIG would get a bump. But that's a bit of wishful thinking.
Yes. Well, okay, let's summarize what we're telling people. By the way, we want to remind folks, any of the people who come to talk with us from Barron's do not own the underlying stocks.
We do not.
That you talk about. And neither do we, for that matter, if you don't know that, here at Yahoo Finance. It's a policy among most journalists, in fact. Let's tell people let's sum up what Al is saying here. Buy American International Group. It's cheaper than Chubb. Business is improving. It's at that point where it's in a place to outperform. The CEO's in a sort of sweet spot. On the other side, you say avoid Chubb. It has now become expensive after Warren Buffett pushed the stock to all-time highs, and there's not much more upside in the next 12 months, either in the stock price or maybe much more profit improvement. Thanks so much for being here. Good to see you, and thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
And time now for some calls of the day. Several analysts raising their price targets on Nvidia ahead of their earnings on Wednesday. One is Barclays, and I have a note from them. Their price target is raised to $1,100 from $850. And one of the things that Ms. Tom O'Malley is writing there, there have been concerns through the quarter of a possible air pocket, and that's a big thing for Nvidia in the middle of the year ahead of the Blackwell launch. That's its latest chip. Although the analyst is saying these calls are seemingly overblown, so maybe just not as bad as people thought. We still do not see evidence of this occurring, with the tone from our checks remaining mostly unchanged. And these come as there's a lot of excitement over this. There's an interview with Michael Dell of Dell Computers and also Huang of Nvidia, and they were talking about putting their resources together and launching these new AI PCs. And Dell says that's going to be the standard next year, and you're going to want to be on that track. If you're buying a new PC, you're not going to want to have the one that doesn't have all the bells and whistles.
Right.
So that's another thing to keep in mind when we talk about the data center, which is over there and really big. Well, personal computers as well.
Yeah, although data center is something like 80% of their business, of their revenue at this point. The Baird note, one of the many folks who raised their price targets, says there is no match to Nvidia's product offering this year and next, which combined with shortening lead times should play well into the second half of the year from a market share standpoint. So there's still a lot of gushing, no shortage of gushing when it comes to Nvidia. Well, sticking with tech here, Microsoft is going all in on AI for the PC. The company unveiling a new category of computers and software during an event this afternoon. Yahoo Finance's Dan Howley is there at Microsoft headquarters. He's got more on the news. We got you running around a lot here lately, Dan. What stood out to you from today's announcement?
Yeah, that's right, Julie. We're here at Microsoft's newest campus here in Redmond. Obviously, you can see behind me, they're talking about a new era in PCs. Basically, the gist of what they were doing was announcing kind of a new refresh, or I guess era, in PCs, where they're going to have their Microsoft Copilot running across all of Windows. And powering that will be chips from Qualcomm, Intel, and AMD. Chief among them, though, Qualcomm here was the most mentioned. It also, in addition to opening up Copilot and adding AI to general PCs, opens up a new front and kind of an exciting front in the overall computer landscape, where Microsoft and Apple are now back going toe-to-toe. And so part of the event was Microsoft basically saying, look, these PCs can now beat the MacBook Air with the latest M3 chip in terms of battery life, in terms of performance, in terms of sustained performance. And they really wanted to hammer that point home. Now, as far as the Copilot integrations, they say that they're running OpenAI's GPT-4o as part of Copilot now. And so users will be able to do things like have their Copilot look directly at their screen. So say you're running, in a demonstration, they showed the game Minecraft. You can ask how to build a sword in Minecraft, and Copilot will be able to see what's on your screen and tell you exactly how to complete that task. Now, sure, most people probably won't be playing Minecraft on their computer. I'll be playing other games, but other people will be doing things like using Office or maybe Adobe apps. And so they say that that'll be able to be something that's integrated as well. They just used the example of Minecraft because it was a nice visual thing for them to do. So the upshot here being that Microsoft, while PCs went through this doldrum period of 2 years of just declining shipments, we just saw the first increase in shipments in 2 years, and now they're hoping to kickstart a whole new cycle with this AI PC era, led by their Copilot Plus PCs is what they're calling them, and some of these chips from Qualcomm, Intel, and AMD.
Dan, thank you so much, and we'll hear more from you tomorrow as all of the excitement continues. And also, we're going to hear more later in the show. In Market Domination Overtime, we'll speak to Qualcomm CFO and COO Akash Palkhiwala about that Qualcomm-Microsoft partnership. Well, economic uncertainty and global competition is driving gold and copper to near all-time highs. We'll take a closer look in our investor playbook on the other side. Commodities have been on a tear, specifically metals. Gold prices hitting a record high today, boosted by mounting geopolitical uncertainty, fueled by the death of Iran's president over the weekend. We're looking at how to navigate the big picture with the Yahoo Finance Playbook, and we're joined by Phil Strebel, Blue Line Futures Chief Market Strategist, and Timna Tanners, Managing Director at Wolfe Research. Thank you both for being here. Phil, I'm going to start with you. It's not just gold, silver, copper. We are really seeing some pretty amazing increases in many of these metals. Does a lot of it have to do, I mean, is it sort of the dual thing here of geopolitics and then AI that's helping fuel this?
Yeah, if you break it down into copper, I mean, when you trade commodities, it doesn't matter what it is. You really got to identify two characteristics when investing. It's a supply-demand imbalance and it's market momentum. You look at copper, for instance, you've got increased electrical power use because of the green energy revolution. You've also got rising demand from electric vehicles, and advancement of AI have also strained the outdated electrical grid. So the combination pushes demand for copper, silver, and other metallic metals higher for the first time in over a decade. And this comes at a time when increased regulation makes it harder for additional supplies of these metals to come to light and end up in the end user's hands. So it's just creating this global deficit right now. It's a perfect storm for commodities.
And Timna, you cover the miners. Can you give us an overview? And these are very different companies, depending on what's mined and scattered throughout the world, different geopolitical structures and things at play. What are factors that the miners are concerned with right now, and some of those that are translating into higher prices down the stream?
Amount of new copper mines starting up this year. There's we can rattle off a couple off the top of our heads. There's Quellaveco, QB2, there's Oyu Tolgoi, and Kamoa-Kakula. So there's quite a bit of copper coming on, and a lot of the new copper demand isn't going to hit the market till 2030, especially data centers, maybe a 1% to 3% global phenomenon over from 2020 to 2030. So there's nothing really very incrementally supporting this massive rally, aside from a small deficit in copper if you look at the data. However, there's nothing to get in the way of a good, the facts don't let the facts get in the way of a good narrative here. The reality is this is really a squeeze that's happening in the financial community more than in the physical market. There's a lot of shorts that were squeezed in copper. It's quite a bit of analysis on that. And definitely, the phenomenon of Russian material not being able to be delivered to the US is causing a physical squeeze. In terms of the miners, certainly they are enjoying these higher prices. It's hard to explain how sticky they'll really be from what we just described. There's the high profile potential acquisition of Anglo by BHP that looks like it's hitting a wall here. But we aren't hearing a massive amount of M&A. Even though it is hard to build, it's also getting expensive to buy.
Well, and Phil, to circle it back to you, if indeed at least a substantial portion of the copper rally is a short squeeze, like if you're not an experienced trader, do you want to try and chase that? I mean, how much sustainability does that have?
Well, this is where you got to really put your thinking cap on. You've got to manage your risk. You've got to manage your position sizing. One of the more recent plays that we had recommended to our clients was a particular call spread, where it's a calculated risk trade, which has a favorable risk to reward ratio, but it also defined the risks involved. So when it comes to investing of any type, you always want to manage position sizing, making sure that it's risk capital that's involved. So if you were going to step into the market right now, on the copper market, you could take some of these calculated risk option plays, or you could look at the micro copper contract, which is only 2,500 pounds. So every penny move, say from something like $5 to 501, would be a $25 positive impact in your account, or a dip down to 499, a $25 negative impact.
Timna, let's stick with risk management here. So the approach that we would have with the futures market, and whether you're investing directly in the futures or an ETF, that's a little bit different than a stock play where you're investing in with miners. How do you go about that? How do you advise clients the best way to approach?
We have coverage names that are a little more liquid, like Freeport. We have names with a nice dividend like Southern Copper, and then we cover tech resources, which we think has the most interesting combination of a little discounted valuation because it's a show me story and execution of their operational ramp up at QB2 and some more interesting growth. So in our view, if you can have copper exposure with copper growth, that's the way to go.
Tim, I want to turn to gold and silver a little bit more now too, because as you look at the miners, I mean, many of them do multiple different metals that they are mining, but I'm curious what you think about the trajectory for those metals and which miners might be best poised to take advantage.
Sure, we don't unfortunately cover precious. We do have exposure through Freeport where they do mine gold. Their Grasberg mine is the largest gold producer in the world, and it's a great byproduct credit benefit to them. It's an interesting market when you see geopolitical risk helping gold, but also copper at all-time highs. It's not usually, they usually go in different directions. So it's an incremental positive for sure for Freeport.
And Phil, talk to me, please, about some of the volatility that we've seen in the futures market this year. I was just looking at a heat map we have on the Wi-Fi Interactive, and cocoa is actually up the most this year. It's up 68%, although it's still down 30% from its highs. Just wondering how investors should consider some of the volatility embedded in these markets before rushing out and investing in a metal.
Yeah, this is where you got to weigh in as far as those mini and micro contracts, account size, and everything else. A lot of the volatility we've seen, is because of the rising geopolitical tensions. You've also seen increased consumer investments and one of the largest speculative long positions that we've seen in the last 2 years in the gold market. So you get geopolitical events, things that happen over the weekend and things like that. You're going to see a lot of that volatility here because of the fact that people are so embedded in the market. They've got so much exposure there, and the more participants you have coming in there, it's like a river and they all rushes in one direction here at the moment. So you always got to keep your one foot out of the door here and be ready to, be the first person to leave. They always have an old saying in commodities, you want to arrive to the party late, but be the first person to leave.
I like that. Timna, I'm going to give you the last word here. Anything we didn't touch on in this discussion that you want to leave with viewers?
I think you can't ignore the 800-pound gorilla in the room, which is China. China accounts for 50% of all demand for commodities that we follow on the metal side. And I think that China's a big question mark. So clearly they're farther along in terms of EV adoption than we are here in the North American market. But, and so that's positive for transmission lines for copper demand. But on the flip side, their property sector is, I'd say, in very late innings of development. You've seen, months now of the completion side reversing, which is usually negative for copper. So are we seeing net copper demand in China or not? I think a lot of that will depend on how these stimulus measures play out. And so far, they've not been that impressive. So I think we have to include China in any of these discussions.
All right. Never forget the 800-pound gorilla. Thank you, Timna and Phil. And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from reports from Palo Alto and Zoom.
And at 4:30 Eastern Time, it is the debut of our new show, Asking for a Trend. We've got you covered with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. There's the closing bell on Wall Street, and now it's market domination overtime. Let's get you up to speed on the action from today's session. Jared and I here at the Wi-Fi Interactive, where we've got the Dow closing lower by about 0.5%, pretty much near the lows of the day here, just a kind of a drift lower. The Nasdaq looks like closing at a record, Jared.
Yeah, it should be a record there.
As did the S&P 500, even though it didn't gain by very much.
Very little.
It only had to
It
gain
only takes 0.001 point.
Exactly. So both the Nasdaq and the S&P.
And we'll do the Russell.
The Russell in the middle there, up about 1/3 of 1%. So we did see some strength in technology today, which was interesting. The XLK, I believe, was the leading ETF, and then financials getting dragged down maybe by JPMorgan there.
Yeah, you can thank JPMorgan and the conference from that. A little bit of forward guidance that the market didn't like. In fact, let's take a look real quick at the financial sector and see how that fared, because it was pretty wide ranging, the losses that we were seeing. And so there's JPMorgan down 0.5%, Morgan Stanley barely in the green, but for most of these guys, it was a negative day. And just looking at some of the other sectors here, communication services in the green, industrials, not a lot of movement to the upside, but to the downside, consumer discretionary, that's retail, and then real estate, staples, energy, all of those down about 2/3% or more.
It feels like everybody's waiting for Nvidia. It's one of those weeks where
last week it was inflation.
Right. I mean, now it's the big event of the week is Nvidia after the close on Wednesday, and so a little bit of waiting game.
There's FOMC drift, now Nvidia drift.
Yeah, exactly. Well, markets closing the day mixed as investors were dealt more Fed commentary that reiterates the higher for longer narrative. San Francisco Fed President Mary Daly assuring there is no urgency to adjust rates. For more on what the hawkish Fed stances mean for investors moving forward, let's welcome in Ross Mayfield, Baird Investment Strategy Analyst. Hey, Ross, good to see you. So nothing here. I mean, there wasn't a clear direction in the markets today. Does it seem like people are sort of zooming in on this Fed speak and just not expecting anything anytime soon?
Yeah, that's basically it. I mean, there's nothing that has really changed the narrative. Obviously, you know, the market is also in waiting mode for big earnings, as you mentioned. So it is kind of, it reminds me a bit of a week where you have a CPI on Wednesday, or, you know, it's one of those first weeks of the month and you're just kind of in waiting mode for the big news, because in the meantime, you do have a lot of Fed speak, but not really saying anything new. No reason to be more hawkish, but no reason to be more dovish either. And you kind of settle in and higher for longer, maybe 2 rate cuts this year. And I think that's probably your base case as of today.
All right, so it's all about Nvidia, but it's not all about Nvidia. In fact, we've seen the rally breadth expanding to include other areas of the market, other AI themes like electrical demand, copper. We've been talking a lot about copper today. What do you see in terms of the market breadth and how that's been improving?
Yeah, absolutely. I think if anything, heading into the earnings, you've kind of had tech kind of reset sentiment, because it hasn't been the only show in town at the top of the market, right? You've had breadth expand. You've seen, you know, some pop from something like utilities. You're definitely seeing things like financials and banks hang in there. Some of the more cyclical, kind of historically value tilt sectors, commodity linked, economically sensitive stuff has been working, while discretionary has taken a pause. So it's a bit more of a mixed market, but it is broader, and all things equal, you'll take more legs holding the chair up, right? And then if you look internationally, obviously the story expands there. There's breadth all over the place if you look abroad. So probably a good thing that heading into a big earnings like that, there's not this historic kind of concentration and high expectations for that sector. I think the breadth is very much a good thing here.
So Ross, bottom line, do you expect stocks to continue to move higher here?
I do. You know, the momentum we saw off the October 23 lows, the breadth and momentum of that rally really historically portends strong intermediate term returns, right? Pretty much everything we saw from October, November, December, January, and on through really the dip in April is something that portends strong returns over, you know, the next 12 months historically. So, you know, we might wobble here as summer volume dries up and hit a bit of a seasonal rough patch. Maybe some additional volatility linked to the election pops up or something geopolitical in the meantime. But around this time next year, I would be hard pressed to not be bullish about that outlook, just based on what we've seen historically. Again, you're seeing it today. You had a bit of weakness in April, and all of a sudden we're right back at all-time highs. Breadth looks pretty good. Leadership is still cyclical, and the economy is hanging in there. So not too much to really scare me at this point.
And so you mentioned international is performing well. Is that a place that you would be looking above the U.S. right now, or are there sort of more opportunities, cheaper opportunities outside of the U.S.?
Definitely cheaper. I mean, valuation hasn't helped you much in international over the last decade. So I struggle to make that the kind of base case there, although there are plenty of value there. You know, a lot of the aggregate PE being lower is just based on industry and sector mix. But there is a lot of opportunity. You are starting to see momentum as a lot of these countries both emerge from kind of mini recessions, you know, the type of which was expected here and didn't materialize. But there are also, you know, Europe and a lot of these big central banks are moving towards cuts or stimulus a little bit quicker than the Fed is, just because inflation has been coming down more rapidly there. So, you know, I come from a wealth management world. We're always kind of fighting the home country bias. So I'm always a little bit of a bull for international, but there's a little bit more to the case than there usually is. And I think you're seeing a lot of momentum. The all world ex-US is plumbing new highs just alongside the Dow and the S&P. So some momentum, some economic, bottoming, and a lot to like abroad.
Yeah, you throw China in there, you could have a real party. We just got a minute left. Anything we didn't touch on here?
I think you very timely comment. I mean, China is kind of, the previous guest, 800-pound gorilla in the room. I mean, as of this time last year, we were talking about, is China investable, period. And now it seems to be carving out a base. There's reacceleration momentum, and there's the state-owned enterprises, but there are still some good businesses there that obviously have, huge addressable markets and a lot of support. Obviously, they're pumping stimulus into the system. This latest round, we'll see. It hasn't worked yet, but they haven't pulled the foot off the gas yet. So I think watching China, and as you talk about things like industrial metals and copper, it's hard not to link that with kind of a nascent, burgeoning China demand. So I think that's a big story over the really the rest of the year here.
Interesting. Thanks a lot, Ross. Appreciate it.
Thank you.
We got breaking numbers now from Palo Alto Networks, the cybersecurity company, coming out with numbers here. A lot of attention on the billings forecast. So I'm going to jump right to that here. For the fiscal fourth quarter, the company says billings will be $3.43 billion to $3.848 billion. The midpoint of that below the $3.47 billion that analysts had been estimating. And there was a lot of concern, a lot of talk about the billings, that was going to be the key indicator. Westpark Capital writing ahead of the print here, the importance of billings as a leading indicator of the business can't be overlooked, and it's forecast to have grown from 2 to 4% from the third quarter. If you look at the billings here that the company just reported, I'm looking for that number, not seeing it off the top of my head, but revenue in the last quarter was up by 15%, just about in line with estimates here. But it does seem that billings number is what's responsible for the drop. Yes, and just looking at some of the revenue numbers that you just quoted, that can be further divided into product revenue. That's $391 million, very small beat there, and that's only up 0.7% year over year, but still a minor beat. Subscription and support revenue, $1.59 billion, that's up 20% year over year, and also just a little bit more than the street was expecting. I do have some other, I don't know if you broke this out specifically, Julie, but you did the year forecast, fourth quarter forecast. We do have revenue of $2.15 to $2.17 billion. Now the estimate was $2.17 billion, so a little bit on the light side. They see billings $3.43 to $3.48 billion. Estimate was $3.47, so a little bit light there when you consider the midpoint. And then they see adjusted EPS as $1.40 to $1.42, and I don't have a comp on that one. Right, but by and large, it does seem like that the forward-looking numbers was what was, sort of spelling some trouble for Palo Alto versus what analysts were expecting. If you look at the shares year to date, they're up about 10%. I have them on the Wi-Fi Interactive here. Let's do that, shall we? All right, so year to date, we are now up 9.8%, but you see this drop here, 8.12%. When we open tomorrow, that number to the right in green is going to be a little bit lower. In fact, it might be wiped out. So we might be heading down to the unchanged line for the year. PanW is an interesting stock. So over the last 5 years, up 326%. You can see basically holding its rather steep trend line. So nothing out of the ordinary here, but I would expect on tomorrow's open to be testing the lower bound there. And so that's going to be the key level probably in play. Let's talk about Zoom as well. Zoom reporting its first quarter results here. That company coming out with earnings per share beating analyst estimates at $1.35, $1.19 is what analysts were expecting on average. Revenue pretty much in line with estimates at $1.14 billion. And Zoom, of course, out with a forecast. Its forecast for the second quarter adjusted earnings per share is below estimates. It's a range, but the top of that range is $1.21 for earnings. $1.24 is what analysts had been anticipating here. So that looks like a disappointment. Also, another big disappointment here. First quarter enterprise customers, 191,000. The estimate was for nearly 224,000.
Wow.
You know, Zoom, as we know, made the pivot after the pandemic to try to really add enterprise customers, business customers, away from its reliance on individuals, because everybody signed up. You know, they had good market penetration. There were fewer people post-pandemic who were willing to pay for it. They especially were focusing on, at one point, large enterprise customers, but then they kind of shifted to also focus on small and mid-sized business. But either way you slice it, that number looks like a pretty big disappointment.
Yes, and I have another one along those lines. Customers contributing more than $100,000 in trailing 12-month revenue. That was 3,883, but the estimate was for over 100, or just about 100 higher, 80 higher, 3,966. So just the mix of earnings and how that breaks down, just not seeing those larger purchase or larger customers in right now.
Right, so we'll keep an eye on that one. Well, Qualcomm looking to advance its AI play. We'll speak to the company's CFO on the other side. More market domination overtime coming up. Qualcomm looking to advance its AI play. The company is set to power Microsoft's next generation of Windows PCs with its AI chips. That announcement coming today at that Microsoft event that our Dan Howley told us about earlier. Joining us now to discuss, Qualcomm Chief Financial Officer and Chief Operating Officer, Akash Palkhiwala. Akash, it's great to see you again. Thanks for being here.
Great being here, Julie. How are you?
I'm doing well, thank you. I'm excited to get my eyes on these new PCs and to test them out. What the Snapdragon chips that are going into these PCs, what kind of capabilities are we going to see from this new generation?
Yeah, so first of all, we're very excited about the announcement today. Microsoft talked about the next generation of PCs with Copilot Plus, bringing in some incredible AI experiences for the consumers into the devices. And so we're greatly looking forward to those devices being launched. What Qualcomm brings to the device is a specific chip that we've built for this purpose. It's called the Snapdragon X Elite chip, and it shows three key new areas. The first one is the best-in-class processing exceeding all other PCs in terms of performance. The second is very, very good battery life. It shows very long battery life, several times extending greater than 20 hours. And this is not something that PCs have had before. And then the third is this incredible set of AI experiences that Microsoft outlined today that for the foreseeable future are only available on Qualcomm Snapdragon X Elite devices. We announced more than 20 devices that are all enabled by our chip that will be soon be available for consumers to buy.
And, you know, we have been talking a lot about the just vast demand that we are seeing for all of these types of AI chips from you and your competitors. There was a comment today from one of the Microsoft executives that the company expects over 50 million AI PCs will be bought over the next year. What does this mean for Qualcomm's sales and bottom line, that kind of demand?
Yeah, I think it's an incredible opportunity for us. We're uniquely positioned to be the primary beneficiary of that growth in AI PCs, and we have a chip that significantly out-contributes any of our competitors. So we're looking forward to it. We think the PC is in the first innings of this new generation, the new form factors, the new performance vectors, and Qualcomm is the one making it happen along with Microsoft.
Akash, can you give me any numbers around it about what contribution you're going to see perhaps to sales this year?
I think we're at the front end of a very long run for the company. This is a massive silicon market, and it's not often in our generation that you get to enter a new market like this that is at this scale with a unique performance advantage product that is leadership, and it's going to be sustained leadership for a long period of time. So we're looking forward to it. And
on a similar front, you talked about your offerings versus your competitors. So if we're expecting this kind of growth in the PC market, what kind of market share do you expect to take, say, from the Intels and AMDs of the world who also make chips that power PCs?
Yeah, I think the way you should think about it is the market transition is happening and Qualcomm is positioned to be the leader in the new PC. And that really, you can kind of extrapolate that into a different set of numbers and we'll see how it plays out. But I really do think we have the best product in the market and we have this opportunity to be a leader in a new market beyond what we've already done in smartphones and in automotive, in XR and in other areas.
Well, and speaking of all the areas that you're in, Akash, you know, I gotta admit to you, we talk about Nvidia a lot on this show, right? It's of high interest to investors. How should we be thinking about the chip universe right now when people are so focused on Nvidia? How should they be thinking about a Qualcomm and its role in this whole AI revolution?
Yeah, I think that's a great question. If you think about AI, it took off in the cloud first. And as you know, we don't have much of a presence on the cloud side, but we're the clear leader on device. And what we're seeing happening, and the event today from Microsoft was really the beginning of that change, is that we're going to see the migration of AI from the cloud, in addition to the cloud, to happen on the device as well. And the PC is just the first device where Qualcomm is enabling it, and we get to see the benefit of it. But you're going to see it happen across phones, tablets, automotive, industrial devices, and Qualcomm will be enabling it across all of these things. And the way to think about on-device AI is really, it is something that enables use cases that cannot happen in the cloud because it has privacy benefits, security benefits, it has latency benefits, and it has a very significant cost benefit because once you buy the device, the compute capability is already available on the device and you can run use cases really for free on an incremental basis. And Qualcomm's uniquely positioned to make that happen, and that's why this is incredibly exciting, and it's the beginning of a new chapter for us.
Akash, great to see you. Thanks for joining us.
Great to see you as well. Thank you very much.
Thanks. Well, Palo Alto Networks reporting third quarter earnings moments ago. Shares are slumping after the close as the company narrowed its full year billings guidance. Here to help us put those numbers in perspective is Deep Instinct CEO. He is also the former Palo Alto Networks CEO, Lane Bess. Lane, it's good to see you again. Thanks for being here.
Thank you, Julie. Happy to be here.
So, Lane, what do you think of these Palo Alto billings numbers and sort of what they say to us about the cybersecurity landscape?
Well, first of all, I'm a little bit more optimistic about these numbers than most people might be. Having sat in Nikesh's seat before, I'm actually feeling that he should be feeling pretty good about these numbers overall. One little known fact, or it's not a little known fact, but it's something that I've seen consistently, even since I was the CEO there, is they're going into their Q4. Their Q4 has historically been a strong finish to their year. It's about salespeople being motivated to make their numbers. So I'm guessing that there was a little bit of conservativeness. You don't want to promise and not meet. So I'm optimistic that Palo Alto will have a good quarter. The market's expanding tremendously. And what Nikesh has done, and I, again, compliment him, is increased his routes to market.
You note in your notes to us that Palo Alto is a platform play, but they're missing something, which is AI. Just talk to us about that mix and how they might plug that hole, if that's even possible.
Yes, well, it is possible. The use of the term AI is getting overused across all industries, including cyber. They do have a platform play, but what customers are looking for right now is more best of breed. And oftentimes the platform players, while they go broad, they're not necessarily building and or acquiring the best of breed. They're trying to put together a lot of different cyber solutions that will serve different customer needs. AI, in terms of prevention, is where the market's going to have to go. And a lot of what Palo Alto does is it creates layers of defense, but it doesn't necessarily use the most sophisticated AI in fighting what's now going to become a more challenging cyber malware attack, generative AI being one of the biggest drivers.
Lane, what are you seeing and what do you see through these Palo Alto numbers in terms of client willingness to spend on this stuff?
I don't think the clients are lessening their willingness to spend. In fact, I think they're seeing more of a need to spend. I've talked to a lot of CISOs. I do it every week. And the bottom line is they've been fatigued by a lot of spend, but the game is being raised in terms of the threats. So I think they'll continue to get larger budgets, but they'll be seeking to solve the problems they haven't yet solved. And the generative AI threats, particularly the ones we're seeing at Deep Instinct, that most of the platform players cannot stop, is going to be a key area to focus on.
It seems pretty clear that you could describe this as a spy versus spy arms race. I'm just wondering, can you give some direction where you see cybersecurity headed as the ante keeps being raised here?
Yeah, it is going to be about deepening the ability to prevent. If we look at the past few years, it's been about detect and remediate. Assume that you're going to be breached. But more and more of the technologies that are going to be coming out are going to be leveraging AI, in our case, deep learning, a very unique capability to essentially predict and prevent threats before they hit you. It's the cost of remediating, the cost of, you could look at MGM, you could look at Clorox, the cost of these attacks is just getting too large. And if you look at it, CISOs, CIOs, and boards, would they rather put more budget into investing behind prevention, or would they rather pay the ransom or the costs to remediate and fix, not to mention the damage to their brand? So the budgets will continue. That's why I think all tides will rise here. I think Palo Alto still has a very strong play, but they're going to have to go deeper. We're voting and we're believing that the AI approach in terms of prevention is going to be the way boards are going to demand.
Do you think in terms of the Palo Alto numbers, you said you read them a little bit more positively than the market, but the market's disappointed in the billings. What do you think is missing here? What execution-wise? But and I'm not really talking about the new products or what you're referring to in terms of prediction, but the existing business. What could they be doing differently?
Yeah, well, this is one of the things when I saw the IBM announcement last week, to me, that's broadening routes to market. That wasn't a product expansion. In fact, both IBM and Palo Alto have struggled a bit in the transformation to cloud. Companies like my last one, Zscaler, are doing much better in terms of accelerating their business in that transformation. You know, in this case, that relationship with IBM is going to give them 1,000 more people selling for them, driving revenue. So I think Nikesh has been clever in expanding his routes to market. He's got a broad set of products. I think where he might need to strengthen the play is on the depth of the AI. The generative AI threat attacks are yet to be seen in terms of their severity. We're planning ahead for that at Deep Instinct, and we've got a solution for it.
Lane, good to see you again. Thank you.
All right, thank you.
Time now for What to Watch, Tuesday, May 21st. Starting off on the earnings front, we'll be hearing from names including Lowe's, AutoZone, and Toll Brothers. Lowe's announcing first quarter results before the bell. The home improvement retailer saw its rival, Home Depot, miss expectations last week. And investors will look to see if Lowe's will struggle too as inflation continues to restrict discretionary spending.
And other names to watch: Xpeng, Macy's, and Urban Outfitters. Macy's reporting first quarter earnings ahead of the open. Analysts expecting Macy's to report net sales to go up about 2%. And they will be listening for any clues about Ark House Management and Brigade Capital Management, their buyout offer.
And finally, we'll hear from multiple Federal Reserve officials throughout the day, including Fed Presidents John Williams, Loretta Mester, Raphael Bostic, and Susan Collins. This coming after comments today from Fed Vice Chair for Supervision Michael Barr, calling the inflation data this year, quote, disappointing.
And that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your market coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's the debut of our new show, Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Yahoo Finance's brand new show, Asking for a Trend. I'm Julie Hyman, filling in for Josh Lipton. For the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. Here are some of the topics we'll be diving into. The S&P 500 hits another record close after a winning week, but a slowdown could be on the horizon. We'll take a closer look at the data driving the market. Plus, spot ETF inflows are helping push Bitcoin prices to record highs in 2024, but not all funds are created equal. We'll have more on which name is falling behind. And Nvidia eyes another blockbuster quarter. We're watching to see if the chip giant's expected earnings beat is enough to fuel more AI enthusiasm. We're just days away from Nvidia's make-or-break earnings report. Estimates are sky high for the chipmaker, implying a year-over-year quintupling of earnings per share, and analysts are expecting it will handily beat those forecasts as it has in the past 5 quarters. Our next guest expects a solid beat for the company on Wednesday. We're joined by Spear Invest founder and chief investment officer Ivana Delevska. It's great to see you again, Ivana. Thanks for being here.
Thanks for having me, Julie.
So you're looking for the company to beat again, but I guess there is a difference between beat and a difference between beat and raise and the shares going up, considering that they've already, almost doubled this year thus far. So what are you expecting on that front?
That's right, Julie. So we're pretty confident that the company will beat expectations. However, what we've been seeing this quarter specifically is that companies beat and raise, but the market, no matter what they report, finds it pretty disappointing. So it wouldn't be surprising to see that to be the scenario. However, I would say that the upside for Nvidia is really going to come in the next 2 years. So if you look at estimates 1 to 2 year out, they're pretty conservative, and we think they're going to have to meaningfully come up. The data center cycle is just in the early innings, and that's what's driving this upside in earnings estimates. And we expect that they're going to deliver closer to 40% CAGR rather than the currently 20% CAGR that it's in the analyst consensus.
And for the folks who don't know, CAGR, compound annual growth rate.
That's right.
So in terms of the themes we're looking for the earnings, there's definitely the data center. That is a huge part of it. I think that comprises something like 80% of their revenue at this point. They still have a gaming business that we should be watching for as well. And then it seems like the other thing that folks are going to be watching for is CapEx, which has been a big theme among big tech companies, but we've perhaps has been a little bit less of a topic for Nvidia. Do you think that's going to be more important this quarter?
Well, Julie, there is a pretty big difference in the business model of the hyperscalers versus Nvidia, right? The hyperscalers being the cloud service providers like Amazon and with AWS and Microsoft with Azure, exactly. So these companies really rely on CapEx to drive their business. So what they're doing is they buy Nvidia chips and they basically sell them as a service. So they're going to have to really ramp their CapEx if they want to be growing their revenues. For Nvidia, it's a little bit of a different story. They don't need to be investing in capital expenditure as much. So they're going to be investing more in R&D and keeping up with the cycle, but CapEx is not as big of a driver for them just because of that dynamic.
Gotcha, and we're not showing CapEx, but we showed operating expenses, which are ticking up on a year-over-year basis.
That's right, and that would be including R&D, right? So R&D would be increasing.
I want to ask you about training versus inference, which is something I hear a lot of talk about here. So we're in the stage of AI right now where everyone's building their models, and the AI large language models are learning, which is the training phase. Then we'll get to the inference phase where those AIs start making predictions, start making leaps of their own, if you will. And I think one of the questions has been, indisputably, NVIDIA has dominated the training phase. What happens as we get further into the inference phase? You seem pretty confident that NVIDIA is still going to be pretty dominant here.
Well, their chips are positioned very well both for training and inference. So we don't really see them being disadvantaged on the inference side. For inference, you can use a wider variety of products. So that is maybe where some of the confusion comes from, where people are thinking, okay, well, do you really need to be using the highest end Blackwell chip, right? Couldn't you be using a competitor's chip? And that is true. So you can use a wider variety of chips when doing inference. However, that market is actually growing pretty significantly, and Nvidia disclosed that it represented 40% of their data center revenues today is being used for inference, and this was 2 quarters ago. So that number may have gone higher over the past quarter. So they're well positioned in inference. I don't think it's necessarily the case that competitors are more likely to disrupt that market. And AMD did highlight on their earnings call or one of the conferences that they attended that they are actually trying to position their next generation chip to be better at model training. So I think over time we're going to see similar performance in both from both competitors.
And then in the 30 seconds or so we have left, beyond Nvidia, I know you're looking at sort of 2 main themes that will fuel outside of Nvidia where AI is going.
So that's right. So we are seeing actually within the data center, there is inside the rack. So this would be the chips that we've been talking about, but there is also opportunities outside of the rack, which is companies that are providing thermal management, whether it's liquid cooling, companies that are providing power generation, power components. So these are really big, massive areas of investment that are going to benefit equally from the data center investment cycle.
And then there's also B2B that you're looking at, right? Business to business kind of, which
That's
there's
right.
a little overlap there, but.
That's right. So our ETF more broadly invests in B2B technology. So within B2B technology, there are several areas. Hardware is one area. Cybersecurity is another area. Data infrastructure is a third area. So what we focused on here is the data center hardware cycle, right? But there are many more opportunities beyond that.
All right, thanks so much. Excited for Wednesday. Thank you, Ivana, appreciate it. Well, the Nasdaq rising to a new record today, boosted by Nvidia, as investors await the chipmaker's latest earnings report. Yahoo Finance's Alexandra Canal joined us now with some of the top takeaways from today's trading day. Hey, Ali.
Hey, Julie. Well, the bullishness on Wall Street continued today. That is my first takeaway. And we saw longtime bear Mike Wilson from Morgan Stanley. He upped his 12-month price target for the S&P 500. So he's right here at 5,400. Now, this is not a year-end target. This is what he expects in May of 2025. But there are clearly others on the street that think we're going to get to that number or possibly above by the end of the year. BMO Capital Markets, Brian Belsky sees 5,600 by year-end. And of course, this comes as we've seen records across the board. You just mentioned the Nasdaq hitting another record today. S&P 500 almost got that record all at the end of the trading day today as well. And then, of course, Dow 40,000, which we hit on Friday.
Yeah, so everybody's getting more optimistic here. And then what?
And then what? Well, Julie, also metals.
Oh, metals. We talked about metals today.
We have an equities rally. We also have a metals rally as well. You see gold trading at record highs, about $2,450 an ounce. Now, this is spurred by the fact that investors largely expect a Fed rate cut at some point. We did hear from officials that there's this higher for longer mantra as inflation still remains sticky, but we did get that cooler than expected CPI print for April. So that is fueling hopes that we could potentially see a cut as soon as September.
And then there's geopolitics as well, because if gold is seen as a haven, right, as a good store of value when things get rough, you had the death of the Iranian president over the weekend, which raised some concerns. What already obviously is tension in the region, that could somehow play into what's going on there. So that seemed to fuel a little bit of the buying as well.
A lot of Asian buyers, a lot of Asian interest as well there for gold. And then we also see silver at 12-year highs around $32 an ounce. Now, what's interesting with silver is that it's very much tied to industrial demand. We saw a lot of that in 2023. So we've seen some pretty big swings across the board. But largely, strategists think that long-term, we can continue to see this uptick. Copper is a similar story where you could see some up and down, but strategists told Yahoo Finance's Inez Ferre that the long-term fundamentals remain strong, and they're also at records about $5.07.
Yeah, we also talked to one analyst today who talked about the short squeeze that we're seeing in copper. So you do have the fundamentals there, but then in some of these markets, sometimes you also get these sort of speculative or technical effects that then can push things higher or lower.
Right. So metals I thought was an interesting story today. And then finally, as we've been talking about, all eyes are on Nvidia's earnings. And this is really the 1-year anniversary from that blowout earnings report that really started this rally. We see the stock up about 200% since that time, up about 100% year to date. And the expectations are really just as high heading into this print. Of course, there's that possibility if we see any sign of weakness, not only could it affect Nvidia stocks, but really all the adjacent AI stocks that have really benefited from this boom. But I mean, you're looking at your screen now, expectations of over 400% returns on earnings, 242% on revenue. So we'll see on Wednesday where this
Yeah, we will see on Wednesday. I mean, remember, Nvidia is also now the 3rd largest company in the S&P 500 by weight. So there's that sort of effect it has. It's accounted for a lot of the earnings growth in the S&P 500. And then there's the ripple effect you discuss among other chips. I will note, we are not going to continue to see these types of numbers likely as we get further out from that blowout quarter that you mentioned, because the comps were going to get tougher and the growth rate will likely to go down. But we've been surprised so far, so we'll see. Surprised
so far, and it's certainly the biggest news that we'll be getting this week heading into that long weekend.
No contest. Allie, thank you so much. Appreciate it. Well, coming up, looking beyond AI, what are the biggest themes driving the market? We'll discuss with a veteran trader next. The S&P 500 and Nasdaq both closing at new records to start the week, and momentum feels pretty bullish, maybe ahead of Nvidia's quarterly results. But beyond AI, our next guest sees two trends at play when looking at the wider market: steadily rising prices and a broad weakening of the U.S. economy. Sounds ominous, sure, but no need to panic. Here's how to play it. I'm here with veteran trader Stephen Sarge Guilfoyle. Sarge, it's good to see you. So as we look at this inflation issue, how should investors be thinking about it?
All right, so I see the economy is evolving from reflation, which we've been into a period of stagflation, which is inflationary without that much economic growth. All right, so what I'm seeing here is you need to price in inflation into your book. Now this is more of a trend trade than it is an investment. So what I'm doing here, rather than put my standard target price, panic point, that whole ball of wax that I usually explain when I explain what I do, this is more where I'm trading the trend as the trend moves on. So it's not really a target price panic point type of thing. It's more of a fluctuating, ongoing thing. The main theme here, I would say, in order to combat inflation, is the commodities trade that you've seen: gold, silver, copper, uranium. I'm in the ETFs that represent all of these places, as well as the physical in silver and gold, as well as electricity. I think you have to be in utilities, because as AI goes on, as Bitcoin goes on, as electric vehicles go on, the demand for electricity isn't going to be what it's been. Demand for electricity nationwide has gone up maybe like less than 0.5% a year for a number of years. From here on out, I think they're expecting 2 to 3% growth per year. So this is going to be an ongoing thing. You're not going to pay a low price for electricity, I don't think, probably for a long time.
So in other words, you're saying pinpoint some of the areas that are going to have consistent inflation, actually, and sort of lean into that and figure out the best ways to play that.
Oh, yeah. And I think what I'm doing right now is I'm maintaining a core position in all of these ETFs and a few other names like Freeport, McMoran, Southern Utility, those kind of things. So I keep a small core position, but as on days where they're up a lot, I sell some. On days where it doesn't work, I try to buy it back. So it's really a rolling ball of wax that has been working for a couple of months now quite well.
And you're also looking, you mentioned the metals, so tell us what you're thinking there and kind of what the best way is to play those.
Well, when you talk about precious metals like gold, now gold versus Bitcoin, I know Bitcoin's not a metal, but it's kind of a metal. I mean, maybe to the people who are really involved in it, it's not, but to an old guy like me, Bitcoin is gold as far as I see it, and probably they're almost the same kind of thing. From my generation, the alternative investment is gold. So I see gold as the way to play that, because gold is less volatile. So I don't have to face the same risk as a younger person. But a younger person might be attracted to cryptocurrencies, especially Bitcoin, because while they face higher volatility, they probably face greater returns over the long run. So I do see them as almost identical parallel trades, but probably separated by how close you are to retirement is whether you should be in gold or Bitcoin.
And what about copper? You know, we've been talking so much about copper being at highs. We had an interesting debate on the show earlier today, or I should say on market domination earlier today, because we're now a different show, about, you know, how much of what's happening with copper is being fueled by the short squeeze versus the fundamentals.
Yeah, I watched that show actually, and I heard your guest who sees I guess less potential for copper than I do going forward. She sees these prices are exuberant. She's right about that. But I see copper as part of my electricity trade, and it's part of not only infrastructure, which we do believe that China, which is starting to come out of recession. China probably will have some kind of infrastructure package, because that's what they do when they've been in trouble. They boost the economy through infrastructure. Here in the U.S., we have almost no choice but to spend fiscally. So I do see copper probably. I don't know if this pace of growth we can see, but it remains part of the inflation trade.
And, you know, is silver just kind of going along with gold here?
Yeah, silver's sort of a precious metal, sort of an industrial metal. It's been red hot, thank goodness. I love it, because I've been in it for too long to make it worthwhile. It's finally becoming worthwhile. And I do like silver. It's still catching up, I think. And I think because it's useful both as a store of value and industrially, I think it probably captures some of the growth that you might not see with gold or you might not see with copper. but it kind of plays the middle. So I do, me at least, I need to be in all three, as well as uranium.
Lots of ideas here, Sarge. Thanks so much. Appreciate it.
Anytime.
Thanks. Coming up, Bitcoin prices got a boost this year thanks in part to spot ETFs, but not all funds are created equal. That's next in our chart of the day. Grayscale CEO Michael Sonnenschein is stepping down after more than a decade at the firm. He'll be replaced in August by Peter Mintzberg, who currently serves as the global head of strategy for Goldman Sachs' asset and wealth management division. And there will be an interim, actually, Michael Sonnenschein stepping down immediately. There'll be an interim person in that place until August. Now, for years, Grayscale's Bitcoin Trust was one of the few ways to play crypto without buying tokens directly. And Grayscale was one of the first firms to launch a spot Bitcoin ETF once it secured SEC approval in January. But it has seen an investor exodus as of late. Let's get to Jared Blickry. It's been a long day, Jared, with more in today's chart of the day.
Thank you, Julie. I don't want to gloss over Michael Sonnenschein leaving the firm because he presided over some really bellwether events. His regulatory strategy was to sue the SEC after they denied the conversion of that GBTC into a spot Bitcoin ETF because it was a closed-end fund and the price had become detached from Bitcoin fundamentals, that is, the Bitcoin prices. So all in all, we did see this rush of Bitcoin, spot Bitcoin ETFs come to market in the middle of January. And these are the flows. Now, we had about 7 or 8, don't quote me on that. And these are only the top ones. But what you're going to notice is Grayscale, they've lost $17.5 billion in flows there. And that directly eats into their fees. But it's precisely because they have higher fees than the rest of the market that a lot of that exodus has occurred. And the principal beneficiary has been BlackRock ETF, and that's IBIT. That's the ticker there. And if you were to compare the total assets, that would be 18.5 for BlackRock. That's 18.5 billion in their IBIT fund versus 19.5 for Grayscale. So all in all, you got these two guys pretty much operating on par now, and it's an incredible race. There was this thought that boomers were going to load up their 401ks with Bitcoin ETFs. That has not materialized, and so I think what we've seen now in the price of Bitcoin is the slow realization that the spot Bitcoin ETF, and this is a year-to-date chart, was a big moment for Bitcoin ETF. It wasn't enough to carry it through and continue that slate of record highs. We did produce new nominal highs there, but if you look at the 5-year chart, these were not that much higher than the highs we saw before. So Bitcoin maybe just putting in this pattern of slightly higher highs without that huge surge that people had hoped for.
We'll continue to watch GBTC to see if there's any changes to their fees and therefore a reversal of some of those outflows. Jared, thank you. Checking in on one ticker that's trending after hours, Peloton shares are sinking after the company said it will sell $275 million worth of convertible notes due 2029. This comes as the fitness equipment maker looks to refinance its debt and return to growth. Why are the shares falling? Well, typically, when you see a convertible offering, it is debt that is convertible into stock. When you have more stock being issued, that dilutes the value for existing shareholders. In other words, more supply of stock means lower value. So that seems to be what's happening in this case. Of course, the longer term trend for Peloton has been downward. The company has struggled post-pandemic with declining demand for its namesake bikes, and it's been trying to make up for that with subscription revenue for its fitness app, which has met with sort of mixed success. Recently had a leadership change, so it's been a rocky road for Peloton, but raising more money here on its quest to turn itself around. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.